Hey everyone, welcome to the Tech and Real Estate Podcast. Today we're going to be discussing data-driven approaches so that you could get started in real estate. Whether you're an experienced or inexperienced investor, you're looking to scale but you don't know how, that's completely normal. A lot of new investors actually get paralyzed by fear and don't move forward. They get nervous about how to become a landlord, how to save money to become an investor, and what if you actually buy your first property but prices drop? What do you do next? If these fears have ever crossed your mind, then this is the video for you. Arley Wolf, who's an experienced real estate investor with over 30 years of investing in various types of residential as well as commercial properties, is going to give us an in-depth overview of how to develop the mindset to overcome your fears with data-driven results. This is one you don't want to miss, so stay tuned and check this video out. Today we have a special returning guest, Arley Wolf. Welcome to the channel.
Hi, Ariel. Thank you so much for inviting me back to your channel. It was really fun and interesting last time, and yeah, I'm glad to be here.
Yeah, so happy to have you back. Going through your product remap and understanding how you use different data sources to have really good data-driven analysis for real estate was super insightful. Has anything come from it over the last 2 months since we last spoke?
Well, I have done some more research, and in remap2.com, there's a section that has my picks, my hot market picks. If you go there, you can find some graphs and some data that supports maybe where the hot markets are.
Awesome. Yeah, can't wait to check it out further. But for this specific piece, really looking forward to diving into what are some investor doubts and how to overcome them with data. Before we get to that, Arley, would love to just hear a little bit more again about your background and how you got into real estate.
Well, so my background, I'll start again. I grew up in a farming community, and on the farm, I worked a lot with my dad, and he taught me a lot of life lessons. And it's there that I learned some really key principles that helped me with investment. And those principles, I'll just bring them back up again, is, buy land because they don't make much more of it. Don't work hard for your money, make your money work hard for you, and work smart, don't work hard. And then today we're going to introduce another principle, which is don't doubt the data. Just don't do it. Don't doubt the data.
I love it.
But so, when, it took me a little while. I don't think I started really investing until I was about 40 years old. But it was something that I was passionate about. I wanted to learn about, and I'm the type of person who is very data driven. I want to make as objective of a decision, especially with such a large, impactful decision as investing in real estate. And so back a long time, 30 years ago, I started to gather data, and I started to pull the data together to look at the history of real estate and let that drive my decision going forward. And now I've just developed a tool that is so much more robust that now helps to put away some of the fears and doubts about real estate. And we're going to draw from that later on in this presentation.
Excellent. Let's just dive right into it then.
Okay, great. All right, I will share my screen. I'll start with talking about something that many real estate investors struggle with, and that is pulling the trigger on an investment. But before we do that, I just go back to those principles again. The buy land because that's supply and demand. Don't work hard for your money. Make your money work hard for you, and work smart, not hard. And then the principle today that we're going to talk about is don't doubt the data, doubt the doubt. All right. So why are people afraid to invest in real estate? Well, I think there's a lot of reasons too. Sometimes you doubt because you just are starting out and you don't have a lot of money to begin with, and you don't want to risk that money. Other times, it's daunting to think that you are going to have tenants and you're the landlord. Some people don't pull the trigger. They doubt because they want to find the perfect deal and they just can't find the perfect deal. Property values are declining at the moment, or property values are appreciating at the moment, and it's too high, of a time to get into the market. And I think this last one is a big one. It is that people feel that they are inexperienced. And that's probably the most common reason that new investors don't start investing. And so, all of this really comes down to doubt and doubting yourself. And so I want to just take a moment to talk about doubt. But on that last slide, you saw a little picture of Shakespeare, and it's from Measure for Measure. It's Act 1, Scene 1. And Shakespeare, I'm going to go back to it. Shakespeare said, our doubts are our traitor and make us lose what we might oft win by fearing to attempt. And that is so true. It is really true. And we're going to try to share with you how we can use data to overcome some of these doubts. I found this on the internet, and I'll share it with you. What is doubt? Doubt is a mental state in which the mind remains suspended between two or more contradictory positions, and you feel uncertainty and confusion. So people often doubt themselves when they have to make a decision or take actions to move forward in life. To make better decisions and take action in real estate investing, you have to make sure that there's nothing holding you back. You've got to find a way to overcome those doubts. And so I'm going to share with you a mindset and some real life data to help you overcome doubts that you or others may have, that will hopefully motivate you to take actions in real estate and begin your journey in building wealth. Okay, so first, let's talk about the mindset. Everything begins with a thought. And so what should that thought be in real estate? Okay, here, try to paint this picture and think about this. I will double my investment. No, wait. I will 5 times my investment in 10 years. It doesn't matter where the market is or what the market is doing now. In 10 years, I will double or triple or 5 times my investment. It doesn't matter if I experience small setbacks along the way, or if a real estate bubble or stock market crash drives the real estate prices down. I will hang on to my property for at least 10 years. So real estate is really in my mind, is really a long-term investment. If you just take little chunks at a time, take snapshots in a moment, and you make your decisions off of those snapshots, it's just, that will cause fear and anxiety, and that will cause you to make decisions that are not the best long-term decision for you. So I'll use an analogy, and that is, Ariel, have you ever made brownies?
Yes.
Okay. Imagine if you just took the flour by itself and tasted it. What would that taste like? Or the baking soda, or the salt. It's not great because you don't have the full picture. You don't have you can't see the end product, right? Making brownies pretty quick. You can do that in an hour or two and you have pretty good results. Real estate investment is like this mixture of brownie that takes 10 years really to develop and turn into something really, really delicious. So the mindset is important. It is a 10-year endeavor. And if you think of it in those terms, rather than, taking the flour and the salt and the baking soda and just tasting it along the way and saying, this is no good, I gotta get rid of this. That will help. That will help you build your wealth. Second is learn from the past. There is a lot of information, a lot of data that helps us to understand what real estate does over time. And we're going to go over that. If you don't have that knowledge, if you don't know what real estate has really done and how it's performed over time, then it makes it tough. It makes it difficult to have that mindset, that long-term investment mindset. So what I'd like to do is I'd like to take a case study in California, and I'm going to ask you a question. So what do you think the price of real estate was in 1968?
In California?
In California. Average price of real estate. Take a guess.
Maybe 200,000?
23,000.
Wow.
Yeah.
Really?
Yeah. We're going to go through this case study. So how about in 1978, 10 years later? What do you think it was?
So maybe 120,000?
Well, that's close. It was 71,000. That's
Wow.
a 300% increase. So, we've seen trends lately, and we think to ourselves, well, the last 3 years, the last 10 years, that's the best it's ever performed, but that might not be the case. So let's do one more. So, and I got to tip down because my notes are way down here. In 1988, what do you think the price was? Average price.
So you like 210?
Close. So it was $170,000. That's 237%, right? Yeah. So let's go right into this. I'm going to show you a graph here. This graph represents California. Okay. And we're going to just kind of step through this, but it's not only California that has realized this appreciation over time. California has done really, really well, but there are other parts in the United States that have also performed quite well. And there are other parts in the United States that have not performed quite well, not that well over 30 years, right? Clearly. But we'll take California to begin with. And we're going to start in 1984. So between 1984 and 1991, there was an appreciation of 100%. So how many years is that? That's 1, 2, 3, 4, 5, 6 years. Remember, we were talking about the rule of 72? Mm-hmm. Okay. So the rule of 72 plays here. So again, I'll just remind everybody that the rule of 72 says, because of compounding interest over time, that if you take the appreciation rate, or it's the interest, if you're like talking about finance, the appreciation rate year over year, if it's 8%, you divide 72 by 8, and that gives you 9. And that's how many years it takes for you to double your investment. And so the investment is, you secure $100,000 home, and in 9 years, at 8% in appreciation, 9 years, you actually have $100,000. That's what your equity would be. And of course, the real estate is the appreciation, compounding interest on steroids, as I say, because that $100,000 that you secure that appreciate, you're only paying $20,000 of that. So,
which is incredible.
That's incredible. Yeah. So, earthquake in 1989, that, as you would guess, drove the market, or the average home sales down because of all the damage and the fear and doubt that presented. But it went down for 1, 2, 3, 4 years, and it only went down really 11%. But people were probably freaking out at that time because, if you were right in here and you just bought a home here, then you would think to yourself, oh, I got to get out of this, right? It's gone down 11%. But then from 1995 to 2001, the dot-com boom drove it up another 100% appreciation over 1, 2, 3, 4, 5, 6, 7 years. And then the dot-com, fiasco drove the market down 10% in 1 year. Again, if you were here and you just took a snapshot, you took a taste of that flower, you'd want to get out of the market. But if you hung on for 1, 2, 3, 4, 5 years, appreciation went up 59%. And then the subprime bubble hit and went down 27%. 27%. And people thought at this time, real estate will never recover, not like it did in the past, the past, 10 years. But guess what? If you bought in 2012, 11, 12, it's really, really appreciated. And, this only goes to 2019. But if you bought in 2019, like some very smart people, or 2020, very smart people like yourself, you have realized incredible appreciation. Do you have any questions about this chart?
Yeah, I do. So I think this is really good to illustrate how even when there's dips, if you hold on to real estate for a period of time, you are going to see an increase. So what do you say to people who say, well, I only want to buy at the dip?
Oh, I only want to buy what?
At the dip. So say like 2012.
Oh, at the dip.
So some new investors I've heard have said, well, when is the next dip going to occur? Because I only want to buy at that period.
I say to them, good. If you can do that, good. And there are tools on the market. I mean, I think that remap2.com, the website that I have, will help you identify when those dips are, if you keep an eye on it, right? But I also say you don't have to buy at the dip. You don't have to buy at the dip because, look, if you buy at the dip here, like at this point in 1994, of course, your appreciation would be 100% in 1, 2, 3, 4, 5, 6, 7 years. All right.
Right.
But if you buy at the peak here, you still have tremendous appreciation, just amazing appreciation. So in real estate, if you want to maximize your investment and wait for that dip, do that. But a lot of times what those people will do is they'll say, hey, you know what? Here's the dip. I'm going to wait. Well, wait, let me see here. I'm going to wait. I'm going to wait. I'm going to wait. I'm going to wait. Oh, I missed the dip. I'm not going to get into the market. That's the doubt that keeps you, from pulling the trigger. And that's what's going to keep you from building this wealth over time.
Great point.
Yeah. All right. So, I'll have to say, it's true that past performance doesn't guarantee future results, but the future results may be even better than the past performance. You have to, if you take a look at this, you can see that could be the case. So I think the trick is to find those properties that have appreciated better than all the other properties over time. That's the trick. How do you do that? And I'll just take you back. remap2.com. There are other, Zillow. You can see trends in Zillow. Although those other websites, it's hard to pull all of that data together to return the markets because those websites are there and focus on finding the deal or finding the house you want to move into. Whereas remap2.com helps you find the cities that are appreciating well over time, or performing, based on whatever indicators that you feel is important. Okay, so let's move on. Have you seen these types of pictures?
I have, and I absolutely love them, but please explain.
Oh, okay. Well, what do you know about them? These are word clouds. What do you know about word clouds?
So usually based off the volume. So in this case, say if we're looking at appreciation, perhaps then Aurora might be the largest appreciation that we see amongst other cities in this area.
Absolutely. That's kind of what they tell you. So I'll tell you how this word cloud was developed. Again, I went back to remap2.com. What I did was I ran an analysis of the best performing cities over 10 years. This is price appreciation only, and cities that are, fairly large, not the really small cities. I entered that into the word cloud database, and then I went and I took year-over-year appreciation every year for the last 10 years, and had those results entered into this word cloud. And so there's 10 sets of data, and the more a city came up, the more prominent it is, on this word cloud over 10 years. So, if you were to ask me, based on history, where would I go to invest right now, I would look at this word cloud and I would do exactly what you just did. So there are like 19,500 incorporated cities in the United States. This word cloud represents a group of cities, not 19,000 worth, but the best of those 19,000 cities. Yeah. And
I see my city at the very top on the roof. It's small, Tampa.
Was it? Okay. Well, even though it's small, it's actually, we have to remember that if it even shows up on here, it's doing pretty well.
Right.
It's doing pretty well. All right. And so, the smaller the city, I mean, we'd have to go and take a look at it. It could mean that, over the past 10 years, the first maybe 3 years of the 10 years, maybe it didn't show up there, but the last 7 years, maybe that's where it showed. We're going to go on to this next slide, which gives you a little more. And I'm sorry that it's not real clear, but I'm hoping that you can still see what's going on there.
Yeah.
All right. So now, Ariel, take a look at these graphs. What stands out to you in these graphs?
The dark blue line is higher than the rest.
Yeah. Okay. So let me share with you that this red line here is the national average. Okay. So these are all of the these are trends of all of the cities, or the major cities that are appreciating well, the big bolded cities that were on that word graph, or that word cloud. And right here, this is, San Jose, California. So you notice that this is way, way high, right? But what you also see that over time, this is increased because the gap gets bigger and bigger and bigger. This is increased, appreciated better than the national average. And the national average hasn't done bad, better than the national average. But if you were a beginning investor and you weren't cash rich, you didn't have a lot of money to spend, you might not be able to invest in San Jose. But if you were rich and you had money, maybe you would want to. The drawback of investing in a city like San Jose is that the cash flow is not great. The
Mm.
closer to the national average or below the national average, the better the cash flow, right? So, but maybe the appreciation isn't quite as well. So this kind of gives you any questions about this? What do you think about this?
Yeah, I think this is pretty interesting, especially looking back at 2012, where all these cities were somewhat close to one another, seeing San
Yeah,
Jose stand out. But as you said, if the cash flow isn't there, appreciation can only do so much for your, cash flow month over month. You don't want to be in the negative.
right, right. And we're talking here, we're talking, oh, I don't know. Let's just take a look at this. This is this orange is Scottsdale, California. So in 2012, you can get a home average, or this is actually median. Median sale price was 250,000, and in 2022, that median, and this is probably, this is January to March 2022. Median sale price was $800,000. A lot of appreciation there. Okay, let's go to the next.
And this chart is from on Remap 2.
No, well, yes. These charts are on Remap 2. The source of these charts are actually from Redfin.
Got it.
Yeah. So you can graph multiple charts in Redfin. All right, now, so this is, again, the red is the national average. These are properties that are lower than the national average. And a lot of these properties, what you'll find is that the cash flow is better, which means that if you're a beginning real estate investor, you'll have a better chance of being able to hang on to that property for, 10, 20, 30 years, if that's what, for the long term. Okay, let's just take a look at something like Detroit, okay? You think to yourself, Detroit? Really? You really want to invest in Detroit? Well, let's take a look at this. So this down here, and it didn't go back as far as 2012 for Detroit, but in 2013, you can literally, the median sale price for a home in Detroit was in 2013, $20,000, $18,000.
Wild.
That's not finding a sale. That is just going on Zillow and finding a home. So with $18,000, you could probably get maybe $400 rent for $18,000, which is great cash flow. Right now, you can still get a home because the median home sale price is, it's $85,000. If you go and take a look on Zillow, and you can, for that $85,000, you can get $1,000 rent, $1,200 rent, $1,400 rent. It's really, really great cash flow. And again, the appreciation, from $18,000 to $80,000. If you had 10 of those homes, you not only did your cash flow, do quite well, your appreciation, you've made a lot of money in those 10 years. So here's the thing. There is a little more risk, in buying in these lower price home, but those are the risks. Again, maybe crime, maybe a little harder to manage, a little more vacancy, but don't look at the snapshot. When I started out in Lancaster, which was on the other graph, where I could buy a house for $100,000, and I bought a couple of homes that were in pretty poor neighborhoods because that's all I can afford. And I did have some challenges, but I hung on to those homes. And in 10 years, I upgraded those homes. And so we're going to talk about that. So I just want to introduce, we talked about number 1 and number 2. the mind set, and the third thing I want to talk about is don't be afraid of failure. So in life, there's always a chance that you will fail, but failure gives you knowledge and experience that will help you to succeed. And I wouldn't call it failure. I would just call it, learning. I go back to, I'll skip it because I can't remember who it was. Oh, no, forgot. Sorry.
I think that's a really great point that you just made because I recently listened to a podcast from Pace Morby's channel, and he stated, even if you are losing money out on a deal initially when you're getting started, that's considered a failure. Those skill sets that you're gaining from that stays with you.
Oh, absolutely. This third point is very, very important, because I've made mistakes. I made plenty of mistakes when I was young. So that was, if we go back to that, there are cycles, right? And when I learned from those mistakes, the next cycle, I did better. And then the third cycle, I really, really did well. So first 10 years, had a few mistakes, still did okay, did pretty well. Second 10 years, did even better. And then the last 10 years, that's where you really, really, gain momentum and wealth. Okay. All right. So let's run some numbers. And
it's always my favorite.
Yeah, absolutely. Okay. So this is just a spreadsheet that I put together. And this goes back to the mindset, and it goes back to the rule of 72. It kind of combines all of that. Okay. So if you could put down $40,000 to secure a $200,000 property in one of the cities that I shared with you, and hang on to it for 10 years, your equity would be $240,000, right? Yeah. If you're performing, if you perform at a rate of, the market performs at a rate of 8% per year, with your initial $40,000, you would have about 240. Okay, so what do you do next? Then you 1031 exchange by putting it into a $200,000, putting down that $200,000, and you have a little left over to buy a $400,000 home, and you hang on to it for 10 years. And by the way, by that time, your down payment is $240,000. It's half of the worth of the property, so you're cash flowing pretty well. So next 10 years, your equity would be $600,000. And then you 1031 it by putting down $500,000 into $1 million home, and you hold on to it for 10 years. And again, your cash flow would be pretty fantastic. After that 30-year period, your equity would be $1.5 million. Wow. If you can think, this is the difference in mindset. If you can think of appreciation in terms of wage or salary, I like to do that for your investment and the time you put into it. At the end of 30 years, with an appreciation of 8% per year, you would be earning equivalent to $304 a day, or roughly $9,000 a month, or roughly $111,000 a year on your investment. And what you're saving, over those 30 years, so what you'll have in equity is $1.1 million. So what do you think about that?
I think that's incredible, but just to take it again by step. So 1031 exchange, what is that exactly?
Oh, yes. So a 1031 exchange is a way to upgrade your investment without incurring tax penalties, which is incredible, right? Because you're doing all of this tax-free. Some of the rules behind it is that whatever you 1031 into, it has to be whatever monies you put in. Let's say you had gained $100,000, right? You gained $100,000. If you sold it, you would be taxed capital gains on that $100,000. But if you 1031 that equity into upgrading to a bigger property, then that is completely tax-free.
Right, since it's like-minded.
Yeah,
Or
and
like
so
that.
I've done that. I did about 2 years, maybe 3 years. Time is flying now. I did a 1031 of three rental properties into a commercial property. And it was absolutely tax-free. I probably saved in that couple $100,000
Wow.
worth of taxes, at least a couple of $100,000, maybe $300,000. So
Amazing. So for, say, someone, a brand new investor, they decide, yes, I want to be able to purchase a property, hold on to it for 10 years, scale up with 1031 exchange. Can they stay in their same market doing this over a 30-year time frame, or do you suggest every 10 years when they upgrade to look into a different market?
Well, I think that's a good question. You can stay in your same market if that market that you're in shows signs of good appreciation. Because there are those a defined market, a set of markets that do really, really well over time, but there are many other markets that don't perform quite as well. And maybe over 30 years, the appreciation rate, rather than being 8% on average, it is more like 3% or 4%. So if you're in one of those markets that are 3 or 4%, I would move my money into a different market.
That makes sense. Thanks.
Yeah, you're welcome. All right. And so let's go back to why people are afraid of investing in real estate. So it's this mindset, right? It's this mindset we have to get into long term. Not enough money. So if you believe that you can turn $40,000 into $1.5 million in 30 years, would you find a way? And if not $40,000, then would you find $10,000 to invest? Could you do that? And people say that I've heard some investors have said that your primary residence is not an investment. It absolutely is an investment. If I were younger, I might not do this, but here's one approach: is move into a market and find work in a market where homes appreciate well. That's how you build your wealth. That's how you build your equity, rather than staying in a market and living in an area that really, you can't invest in, or because it's too high, or, the home that you've purchased to live in is just not going to appreciate. So.
Yeah, I think that's a great approach. That's one of the reasons why I decided to move over to Tampa. But going on with mindset, sometimes I hear some new investors say, oh, well, the market is saturated. There's so much data available. It's overwhelming. There's so many players like hedge funds that are in this game. But as you said, if you could find a way to, say, get that 10K, 40K to start off with, there's so many actually opportunities today. There's the gig economy. So you could drive Uber on the side if you need to. You can be a freelancer on the side as well. So even though there could be more competition today, I do agree that it is mindset, and you can still overcome it by some of the things that we have today that weren't available, say, 10, 15 years ago. Yeah.
I have a friend. Now, he's not an investor, but he was a really smart guy. When he graduated college in San Jose, he purchased a home. He couldn't afford the home. He couldn't afford to live in there himself. So what he did was he rented the home out to other college students. That helped him to pay to pay his mortgage. And you saw what happened. He bought his home in early 90s, and now it's worth so much more. And what he's doing is that he probably paid it off quite early. His family grew up. He still lives in that home. His equity is just through the roof. But besides that, he is living in a market where where the salaries are really, really high, and he doesn't have a mortgage to pay. So he's got that much more income to invest in real estate or other things. So
yeah, it's incredible. He house hacked early on, got creative of renting out, whether it was the house itself, other bedrooms. So that's a great way to get started.
Yes, if my kids ever watch this, I will encourage you to do the same. All right. The daunting task of being a landlord. Okay, so could you deal with a tenant if you thought of them rather as being a tenant, but being an employee that is producing revenue for your company, because that's really what they're doing. And sometimes you have good employees and sometimes you have bad employees, but there are ways to protect the landlord and also the renter. But just change your mindset a little bit about your tenants. And what I try to do, and it's easier to do now than it was when I first started, is I always keep my rents lower than market rent, quite a bit lower actually. And what I found was that over time, because I was able to do this, my tenants are great tenants. They don't ever want to move. They're typically not late on their payments or anything, because they have a nice landlord, I guess. And they know that where they're living is very competitive with with other rentals that they could be getting. All right, hoping for the perfect deal. Let's address that. So again, with the law of compounding interest, you don't need to find the best deals. You just don't. And I think we already talked about this. You just need to get into the market at some point. Property value decline, property value appreciate. If you take a look at it over a 30-year period, there's, if you worked and tried to save your money with all of the expenses of living and everything else, I found that I was not able, before I got into real estate, to save much money. But with real estate and equity growth, really was able to build wealth fairly quickly. Okay, inexperience. All right, so yes, when you first start out, you're going to be inexperienced, but you will gain experience over time. Don't give up. It's not a 2-year, 3-year endeavor. It's a 10, 20, 30-year endeavor. Over time, you'll build experience. You'll make mistakes at the beginning. Just hang on. I think the only caution I would give people, which my father gave me, is don't over leverage. Don't over leverage. That is too risky. Just invest what you can comfortably do. Now, that doesn't mean that you don't have, you might have to initially give up your coffee or live with a roommate or take those types of measures initially. But be careful about over leveraging, having too many loans, and not being able to hang on to those properties. Why are people afraid to invest? I think it's clear because we do doubt ourselves, and a lot of times we can't see the forest for the trees. We don't have that big picture. I'm hoping that some of the things that I've gone over today will give you that big picture, help to put some of those doubts to fear, And I just want to leave you with this saying from Susie Chasm, doubt has killed more dreams than failure ever has. And I think that's really true. And I encourage you, go and check out the remap2.com website. If you have any questions, feel free to email me at Arley, A-R-L-E-Y, at remap2.com. And I will certainly do my best to answer your questions.